Hi, everybody. Welcome to another edition of Kuvera Insights. Today we have with us Shriram Ramanathan from L&T Mutual Fund. He heads fixed income at L&T Investment Management. Shriram has over 20 years of experience in the fixed income markets. Before L&T, he was the portfolio manager at FIL Fund Management, and he was a senior investment manager at Global Emerging Market Debt Asia at ING, Asia Pacific in Hong Kong. He's also worked with Zurich Asset Management in fixed income research and with the treasury team at ICICI Bank. So all in all, a seasoned fixed income professional with more than 20 years of experience. Shriram is by qualification, he's a CFA charter holder, and he has a MBA from XLRI Jamshedpur. He's an engineer from the University of Mumbai. A very warm welcome, Shriram, and thank you so much for joining us today.
Thank you, Neelabh, for having me on the show. Yeah.
So our topic today for discussion is to understand what is, in the context of mutual fund investments, what is a roll down strategy? How should, as investors, how should we understand a roll down strategy? And whether these, how to differentiate between funds which, or mutual fund schemes which follow a roll down strategy versus others that don't, and whether these have a place in our investment portfolio or not. So we'll kick off the discussion by starting in, spending some time in trying to understand what exactly is a fixed income roll down strategy. Shriram, over to you.
Sure. Thanks, Neelabh. So I think best way to make our viewers understand what's a roll down strategy is to go back to a product that I think many of us are very familiar with, which is FMPs, fixed maturity plans. So I think a lot of us have, over the last 15 odd years, sometime or the other, I'm sure, invested or thought about investing in a fixed maturity plan. Specifically, those kind of products are close-ended funds, first of all, FMPs, right? Which means that you have an NFO or new fund offering. There is a window during which all the investors who want to invest in that fund can get into that fund. It's usually a few days to a week or so. Upfront, it is made clear what is the maturity date of that FMP. Typically 3 years or 4 years or 5 years, depending on the tenor that one chose. And the money comes into the fund. The fund manager would have the ability to invest in that particular FMP, those proceeds, such that every investment in that fund will mature on or before the maturity date of that FMP. And so what would happen is, let's say if you have a 3 years, 3 months FMP, I would have securities which would be either 3 years or a little bit higher, 3 years, 2 months, but not something that is 3 years, 4 months, because that is not allowed by SEBI. So which means that every investment has to be 3 years, 3 months or less. As we near to that date, all of my underlying investments will mature. And by the end of that, or let's say at the time of the maturity or the end of that FMP period, which is 3 years, 3 months in this example, all my securities would have matured. I would have cash, and all of that would be returned back to the investors. So that's the way an FMP worked. Of course, within this, one nuance is that the credit profile of the underlying investments is also kind of mentioned upfront in terms of what a fund manager or the fund house intends to do, and that is adhered to during that period. So that's an FMP. Over time, what has happened is one feature of that FMP, which let's say is something that may not have gone down necessarily that well with a lot of investors, and something that needed improvement, is the fact that it is close-ended, which means that you put your money in at the beginning, you cannot take it out for whatever reason till the maturity of that FMP. It's locked in. Yes, for namesake, you could trade that FMP on the exchange, but the liquidity is very, very poor in those, and which was a pain point with that type of product. The second pain point from a fund manager perspective, the first one was from an investor's perspective. The second from fund manager's perspective is that you're very, very restricted in terms of that final date of that FMP, which is the maturity date of the FMP, which means that I cannot, even if there's an excellent bond, which gives me all what I want as far as that FMP is concerned, but it has a maturity which is 1 day later than the maturity date of that FMP. I could not buy it into that particular FMP because it would be violating a basic SEBI rule regarding FMPs, that not a single security can have a maturity date which is longer than that FMP maturity. So those were some of the issues. Third, of course, and I'll touch upon that as well, is obviously everything that we have seen in the credit markets, right? I mean, over the last 2.5 years, it's been a lot of action, most of it unpleasant. And that leaves a bit of a worry in an investor's mind as well. Hey, first of all, I need to get into a product which is completely closed. I cannot get my money back. And
Yeah.
in between, I have to take a leap of faith and hope that the fund house does not take any securities which default or anything else happens, because I'm stuck in that fund. So these were some of the, let's say, shortcomings of an FMP product. What has happened over the last, I would say, 3-4 years, especially maybe a little bit before that as well, I think industry has evolved with its own small little innovations, etc., wherein this particular category that you refer to as roll down products have slowly emerged. And they basically attack each of these shortcomings of an FMP. Let's start off with the close-ended nature of an FMP, right? The good part about a roll-down product is that it is a usual debt, open-ended debt fund. I mean, it could be a banking and PSU debt fund from one of the fund houses. It could be a corporate bond fund from one of the fund houses. These are plain vanilla categories that are approved by SEBI, which have preset characteristics built into that. It's just that that particular fund house has decided to position it very clearly as a roll down product. So, which means that it is a open-ended fund, right? So an investor can come in. If, let's say, suddenly 3 months down the line, there is a sudden requirement of money, even if that particular roll down product, and I'll come to that, has a final an intended term of, let's say, 3 years or 5 years, there's nothing to stop an investor from saying, sorry, I want my money back because I have a requirement, or because my view of the world has changed suddenly, and he can exit the product and he can get his money back. So that's the first drawback getting addressed in this. Second is, like I said, from a fund manager perspective, that in a regular open-ended fund or a regular debt fund, as we all know those, but which are, let's say, positioned by the fund house as a roll down, I am not locked into that particular date. What we are really trying to do is, if we are having to have, let's say, let's take an example, a 5-year roll down strategy. We are in, let's say, December 21. What that means is, broadly, as a fund manager, I am targeting to have a December 2026 as the average maturity which of that portfolio. But I can have some bonds which mature, let's say, in June 2026. I can have some bonds which mature in June 2027 as well. Overall, broadly, on an average, if I take the entire portfolio of, let's say, 15, 20, 30 securities that I have in that particular portfolio, they would have an average maturity of, let's say, December 26. And that's the way we are delivering on the maturity part of it. And that's also the reason why it is referred to also as a passive strategy, because this is not so much based on an interest rate view, and I'll touch upon that later in our Q&A as well. It is just that we have pre-decided that this particular roll down strategy is going to target December 2026 as the broad maturity of my portfolio, and all my securities will be in and around that. So that's a second drawback getting addressed in terms of, from a fund manager perspective, it gives us that degrees of freedom that we require to construct a reasonably good portfolio. Many times, actually, a much better one compared to if the same thing had been delivered in an FMP format, because I no longer have that particular restriction of that final maturity date.
Right.
Third important distinguishing factor is the credit profile, right? Now, over here, typically, and that's where roll down products have taken a leaf out of FMP and have tried to improve on that. Uh, what an investor, and I'm sure all our listeners also probably expect when they get into any fund, and specifically, let's say a debt fund, is that they should have predictability. They should know what is exactly is this particular fund going to do. And again, like I said, in the context of the what has happened over the last 2-3 years in terms of credit issues, they want to be clear. Hey, is this fund going to buy mainly banking and PSU kind of bonds which are AAA rated? Is it going to buy other AAA rated bonds? Or is it also planning to do some amount of AA minus bonds? Everything needs to be communicated upfront. And over here, that's where no a roll down product needs to overcome that particular issue of providing that confidence and predictability to investors, and that happens through various forms of communication, because that part of it you may not necessarily find in the offer document or anything in a tab. Of course, if I choose a corporate bond fund as my underlying product to do a roll down product, I would still be constrained by the fact that a corporate bond fund has to be 80% in AAA, 20% in non AAA. Similarly, if I choose a banking PSU, I would be constrained by that particular categories, but that's very broad. What people want is that next level of this thing. Are you going to buy even 1% in a non AAA asset or not? Why don't you tell me that? And that part of it comes entirely through repeated communication. It is up to the trust that a fund house can get communicate to its investors. And so that's the way the third problem of credit and the positioning of a fund gets overcome in a roll down strategy. So if you put all these things together, you have two big issues that get sorted out. And those are the two big things that determine returns in a debt fund, right? One is maturity of the fund. That is kind of already pre-known, pre-decided, because you know that that particular fund is targeting, like I said in our example, at December 2026 maturity. So that part of it gets ironed out. Second, from a credit perspective, it is also communicated abundantly clear, and that's now we have a track record of almost 4-5 years of various roll down products that are there in the industry. Just like we do, others also have such kind of products. And the good part is they have evolved over time, wherein the communication is crystal clear from fund houses. This is what we are intending to do in this, and we are not going to deviate from that, even though it may not be mentioned in the offer document. And that credibility getting built up takes care of the second issue, which is credit. So in conclusion to your question, because of the predictability part, compared to an open-ended active fund, because that is the other side of let's say if you had to split out debt funds into two broad categories. Of course, there are many categories, but on this particular aspect, if you were to split it out, you would have a set of funds which are active, which means that the fund manager will decide what to position that fund based on his or her view of the way interest rates are, of the way credits are going, etc. And you have this other universe, which are roll down funds, which are kind of passive funds, but which deliver predictability, and which we'll come to that in a bit, I'm sure, but which play a very important role as far as asset allocation from an investor's perspective is concerned.
Right. No, fantastic. That's a great and great explanation, and thanks for getting into some of the details. I had some questions around the same. You mentioned FMP. Traditionally, I mean, I would also like to just bring this in. FMPs typically would have larger ticket sizes as well, because they were meant for a certain. I mean, a lot of FMP products are around optimization of for taxes. So
Right.
they would span different financial years so that investors
Indexation
can get
benefits.
tax
Correct.
optimized returns.
Correct.
And therefore, in many cases, we would see, apart from being closed-ended, they had higher ticket sizes also. So does that apply to roll down funds also, or roll down funds would have, like normal other debt funds, they would have similar ticket sizes?
So roll down funds are basically just like any other debt fund. I mean, so the ticket sizes can be as small as one desires it to be. So there is really no restriction at all from that perspective. And importantly, like I said, uh, rolled on products, in fact, the way they have evolved, um, FMPs to a large extent used to be dominated by institutional requirements. Large investors would have a certain requirement. Accordingly, you get scale and size,
Right.
and because it's an NFO, it's a new fund offering, so you needed those large ticket sizes, and that would dominate the way that FMP is positioned. The good part in an open-ended fund, which follows a roll-down strategy, is that there is no closure date. It's not that in 1 week's time I need to stop inflows in that fund. I mean, if you look at some of the open-ended roll down strategies out there in the industry, or like I said, even at our end, they have been in existence over the last 2.5, 3 years at least. And the fund may not have built much assets in the initial 2, 3 months, but then you
Right.
see phases wherein it slowly builds up. The overall story of the interest rates goes in a particular way. There'll be certain time periods where money comes in more because it fits into asset allocation of a lot of investors, and so it follows that kind of a trajectory as far as the buildup of that fund's assets under management is concerned. What that also means is that it is generally meant to cater, in fact, I would say, to a lot more to long term players typically. By long term, I mean people with an investment horizon of 3 years, maybe sometimes 5 years. Products which are actually even longer, like 7 years, 8 years, kind of investment maturity. And so, in a way, you are in those kind of long dated products. What you're trying to really compare such a product with is something like a tax free bond. I mean, we are all used to tax free bonds in that 7 year, 8 year, 9 year maturity,
Right.
and you would have rolled down products which, let's say, give the pros and cons, because everything has pros and cons. You would compare that to that, and finally put that up as an option to investors. So to your specific thing, in fact, roll down products, I would say, to a larger extent, really are targeted at retail investors, HNI investors, private banking, and you would of course find institutions also come into it, but that depends on the overall interest rate scenario. So they would come in, they would go out depending on their needs. But the core of it, at least what we have seen in our funds, in our roll down products, is a lot of it is actually HNI and retail.